A self-employed business owner made $847,000 last year and paid zero federal income tax completely legally. Before you think that's illegal, let me show you the three-word strategy the IRS actually designed for this exact purpose. It's called buy, borrow, die, and if you're self-employed making over $100K, you're leaving six figures on the table by not understanding this. Most CPAs won't tell you this exists because, frankly, most of them don't use it themselves. The ultra-wealthy have used this blueprint for decades. But here's what nobody mentions. Self-employed people can actually deploy it faster than trust fund billionaires. Because you control something they never will, and we're going to weaponize that advantage in the next 40 minutes. I'm breaking down the exact system that lets self-employed millionaires convert taxable income into permanent wealth without the IRS ever touching it, using assets you can start building this quarter, not when you retire. But first, you need to understand why everything you've been taught about taxes is designed to keep employees compliant and business owners poor. See, when you work a W-2 job, you earn money, the government takes their cut immediately, and then you get to spend what's left, that's the earn tax spend cycle, and it's a wealth trap by design. But self-employed people who understand the game operate in reverse, and the tax code actually rewards this. The wealthy operate on earn spend tax, they earn money, immediately convert it into assets that don't trigger taxes, spend against those assets through borrowing, and only pay taxes when they're long gone. That probably sounds complicated or out of reach, but stick with me because in about 8 minutes, you'll see exactly how a freelance consultant making $180K uses this to pay less tax than someone making $60K. If you're self-employed and you're tired of watching your tax bill climb while billionaires pay nothing, subscribe and hit the like button because this is the actual playbook, not the sanitized advice your CPA gives you. Now, let me show you why the IRS doesn't just allow this. They designed the tax code specifically to encourage it. According to ProPublica's analysis of IRS data from 2014 to 2018, the 25 richest Americans paid an effective federal income tax rate of just 3.4%. Jeff Bezos paid 0.98%, Elon Musk paid 3.27%, and Warren Buffett paid 0.1% in certain years. You're probably thinking they have armies of lawyers and offshore accounts, but the actual mechanism is shockingly simple. They don't sell their assets, so there's no taxable income event. Instead, they borrow against their asset value at interest rates between 2 to 4%, live off the loan proceeds, which aren't taxable, and the assets continue growing tax-free while they do it. And here's the part that changes everything. For self-employed people, you can start building this exact system with $50,000 in assets. Most financial advice tells you to max your 401k, pay down debt, and save for retirement. That's the employee wealth plan, designed to keep money locked away for 30 years while the government taxes you on the way in and the way out when you withdraw. Self-employed millionaires do the opposite. They build accessible wealth that works for them now, not when they're 65. Let me paint you a picture of two people both earning $150,000 annually. One is a W-2 employee at a tech company. The other is a self-employed marketing consultant running an LLC after 10 years. One has $380,000 in net worth. The other has $1.2 million. Same income, same time period, radically different outcomes, and it has nothing to do with investment returns or luck. The W-2 employee pays taxes. First $150K gross becomes roughly $108K net. After federal, state, FICA, and local taxes, they save 15% of that net, about $16,000 per year, invested in index funds at 8% annual returns for 10 years. Not bad, right? They did what everyone says to do, except they're playing an entirely different game than the consultant. The consultant also earns $150K, but immediately runs $45,000 through legitimate business expenses, home office deduction, vehicle expenses, equipment, software, SEP IRA contributions, health insurance, all pre-tax spending that would have been post-tax for the employee. So the consultant's taxable income drops to $105K instead of $150K. That alone saves about $13,000 in taxes annually. But we're just getting started. That consultant now takes their after-tax income, roughly $75K, after all legitimate deductions, lives on $48K, and invests $27K annually into a taxable brokerage account. But here's where the strategy diverges completely from traditional advice. Instead of just dollar cost averaging into index funds forever, they're building collateral assets specifically chosen because banks will lend against them. After 3 years, that consultant has $95,000 in their taxable brokerage account, blue chip stocks, dividend aristocrats, S&P 500 index funds, and now they walk into a securities-backed line of credit conversation with their brokerage where they can borrow up to 50-70% of the portfolio value. They don't touch the principal, they don't trigger capital gains taxes, and the interest rate is typically 2 to 5% lower than most mortgages. So let's say the consultant wants to buy their first rental property. They need $40,000 for the down payment. Instead of selling stock and paying 15-20% capital gains tax on the growth, they borrow $40K against their portfolio at 4% interest, roughly $1,600 per year in interest cost. If they had sold the stock instead, they'd pay $3,000 in capital gains tax on a $20K gain, plus lose all future growth on those sold shares, borrowing costs $1,600 annually, but preserves $40K continuing to compound. Now they own a rental property producing $1,200 per month. After expenses, that's $14,400 annually. And because of depreciation deductions, most of that rental income is tax sheltered, meaning they're building equity and cash flow without adding to their tax burden. And here's where the compounding accelerates, because that rental income can now service the securities loan interest with money left over. The $14,400 rental income covers the $1,600 loan interest, with $12,800 left over. That excess goes back into the brokerage account or toward the next property down payment and the original $40K in stocks that secured the loan, still growing at 8 to 10% annually, completely untouched. This is asset layering. Each asset produces income or growth. You borrow against appreciation without selling, and you're building multiple wealth engines simultaneously without tax friction. After 10 years, the consultant has a $340K brokerage portfolio generating dividends, 3 rental properties with $280K in equity, producing $3,200 monthly cash flow, and their business still throwing off $150K plus in annual income, total net worth $1, $2 million, with $38,400 in annual passive income. The W-2 employee with the same income has $380K, all locked in retirement accounts they can't touch without penalties. The consultant has accessible, leverageable wealth working right now. But you're probably wondering, how is this avoiding taxes? They're still paying tax on the business income, right? Absolutely. And here's the critical shift in thinking. They're not trying to avoid all taxes. They're avoiding taxes on wealth building, which is where the real money compounds. The income funds the lifestyle, the assets fund the future, and because they're borrowing against assets instead of selling them, the wealth compounds tax-free indefinitely. Think about this. If that consultant wanted to access $50K for any reason, they don't have to earn $75K in business income and pay $25K in taxes. They simply borrow $50K against their portfolio at 4% interest, pay $2,000 per year in interest, and the $50K in collateral keeps growing tax deferred. This is why the ultra-wealthy can show $1 in income and live like they make $20 million they're not earning. They're borrowing against their net worth. And here's the advantage self-employed people have over trust fund billionaires. You can accelerate this system because you control your income timing, your expense structure, and your entity classification a W-2 employee can't, and someone who inherited wealth never had to learn the discipline. So let me show you the exact buy, borrow, die breakdown. Starting with the buy phase, which most people get completely wrong. The buy phase isn't about buying cool stuff or building a lifestyle. It's about acquiring assets that appreciate, produce income, and qualify as collateral for low-interest loans. Those three criteria are non-negotiable, and if an asset doesn't check all three boxes, it's not part of this strategy. Most self-employed people fail here because they confuse asset building with status spending, and the difference costs them decades of compounding. Let me introduce you to Rachel, freelance software developer, 34 years old, earning $140K annually after business expenses. She spent her first 3 years buying a Tesla, upgrading her apartment, taking expensive trips, convincing herself she deserved it after years of grinding. She had income, but zero assets. Then she met a mentor who asked her one question that changed everything. The mentor asked, if you stopped working tomorrow, how many months could your assets cover your lifestyle? Rachel's answer was 0, because she had no assets producing income. Her Tesla was depreciating, her apartment was rent, her trips were memories. Nothing was working for her while she slept. That moment broke her, not in a shameful way, but in a clarity way, and she committed to the asset first rebuild starting that week. Rachel sold the Tesla, downgraded to a reliable used car, moved to a cheaper apartment, and redirected $36,000 per year into what she called her Freedom Fund, a taxable brokerage account specifically built to qualify as loan collateral, not retirement savings locked until 65. She focused on 3 asset classes that met the criteria, and this is the exact breakdown every self-employed person should understand. Asset Class 1. Blue chip dividend stocks and S&P 500 index funds. These appreciate historically at 8 to 10% annually, produce dividends quarterly, and brokerages will lend against them at loan-to-value ratios of 50-70%, meaning a $100K portfolio can secure a $50 70K line of credit at interest rates typically between 3 to 5%. Rachel allocated 60% of her Freedom Fund here, $21,600 annually, because it's the most liquid and the easiest collateral to access. Asset Class 2. Rental real estate, single-family homes in stable markets appreciate at 3 to 5% annually, produce cash flow monthly after expenses, and qualify for cash-out refinances, or HELOCs, at 75-80% LTV, with interest rates around 6 to 8%, slightly higher than securities loans, but still far cheaper than selling and paying capital gains. Rachel allocated 30% here, $10,800 annually, saved for down payments, with a goal of buying one property every 18 to 24 months. Asset Class 3. Business, equity, and intellectual property. If you're self-employed, your business itself is an asset that can be sold, licensed, or used as collateral for SBA loans or business lines of credit. Rachel started building systemized service packages, templates, and processes that generated revenue even when she wasn't actively working. She allocated the remaining 10%, $3,600 annually, into building and protecting her business IP, which eventually became her highest returning asset. After 3 years of this asset-first discipline, Rachel had $78,000 in her brokerage account, $35,000 saved for real estate down payments, and a business generating $15,000 annually in passive income from templates and courses. Her total asset base was $128,000, and she hadn't sold a single thing to build it. Now watch what happens when she moves from the buy phase into the borrow phase. This is where wealth velocity explodes. But before we get there, let me address the obvious question. You're thinking, how do you build $36K in annual savings when your income fluctuates wildly month to month? Because that's the self-employed reality nobody talks about. And if you can't solve cash flow volatility, this entire strategy collapses. Rachel used something called the baseline method, and it's the exact system that makes buy, borrow, die actually work for self-employed people. The baseline method works like this. Calculate your lowest earning month from the past 12 months. Multiply it by 1.2 to give yourself a small buffer, and that's your lifestyle baseline. Everything above that baseline goes immediately into assets, no negotiation, no exceptions, no matter how high your income climbs. Rachel's lowest month was $5,200, so her baseline became $6,240, even when she had $18K months. She lived on $6,240 and invested the rest. This created psychological freedom instead of restriction. She knew she could survive on $6,240 because she'd already done it. So every dollar above that felt like found money, money she could aggressively deploy into wealth building without fear of running out, because her baseline was already proven sustainable. Most self-employed people do the opposite. They live based on their best months, panic during slow months, and never build consistent savings momentum. They make $15K one month and immediately upgrade their lifestyle, nicer apartment, eating out more, new subscriptions. Then when they make $6K the next month, they're stressed, dipping into savings, feeling like failures. It's an emotional roller coaster that destroys wealth building even at high income levels. Rachel eliminated that cycle entirely, and within 36 months, she was ready to deploy the borrow strategy that turns assets into infinite tax-free income. But here's the part most people miss about the buy phase. You're not just buying assets, you're buying time for your money to compound before you need it, time for assets to appreciate before you leverage them, and time to learn the discipline of delayed gratification before you scale up. The wealthy understand something fundamental that everyone else gets backwards. You buy assets with income, but you fund your lifestyle with borrowed money against those assets. That sentence probably sounds insane. If you've been taught traditional financial advice, borrow money to live, isn't debt bad? But there are two types of debt: consumption debt that makes you poorer, and strategic leverage that makes you wealthier, and the tax code treats them radically differently. When you borrow $50K on a credit card to buy furniture, you're paying 824% interest on depreciating assets wealth destruction. But when you borrow $50K against your stock portfolio to buy rental property, you're paying 4% interest. The loan isn't taxable income, the interest might be deductible, and both assets are appreciating. Let me show you the exact math on why strategic leverage beats selling assets every single time. If Rachel has $100K in stocks with a $40K cost basis and she wants $50K in cash, she has two options: sell the stocks or borrow against them. If she sells, she pays 15-20% capital gains tax on the $60K gain. That's $9,000, $12,000 in taxes immediately, leaving her with only $88K minus $91K in total value. But if she borrows $50K against the portfolio at 4% interest, she pays $2,000 per year in interest, keeps the full $100K portfolio continuing to grow at 8 to 10% annually, and the $50K loan proceeds aren't considered taxable income. So she has $150K in total value working for her instead of $91K. Over 10 years, that difference compounds into an additional $340,000 in net worth, and that's just from one $50K decision. This is why billionaires show $1 in income. They're not selling assets and triggering capital gains. They're borrowing against appreciated assets at rates lower than the asset's growth rate, creating infinite leverage where the interest cost is less than the asset appreciation. And self-employed people can deploy this exact structure starting with $50K minus $100K in assets. You don't need billions, you just need the right asset types and discipline to not touch the principal. So to summarize the buy phase, acquire assets that appreciate, produce income, and qualify as collateral focus. 60% on liquid securities, 30% on real estate, 10% on business equity, live on your baseline income regardless of fluctuations, and invest everything above baseline immediately before you can spend it. Once you have $50K minus $100K in this structure, you're ready for the borrow phase, and this is where your tax bill drops to almost nothing while your lifestyle quality skyrockets. But before I show you exactly how to set up securities-backed lines of credit and HELOCs, let me show you the single biggest mistake people make in the buy phase that disqualifies them from the entire strategy. And I made this mistake for 2 years before someone slapped sense into me. The mistake is buying the right assets in the wrong account structure, and it blocks you from accessing cheap leverage completely. Here's what I did wrong. I built my first $80K in assets inside a Roth IRA and traditional IRA because everyone told me to max retirement accounts first. Those accounts grew beautifully, but I couldn't borrow against them, couldn't access the money without penalties, and they did absolutely nothing for my current lifestyle. Meanwhile, my lifestyle was still broke because all my wealth was locked in accounts I couldn't touch for 30 years. I had net worth on paper, but no leverage in reality. That's when I learned the critical rule. Retirement accounts are for employee wealth building. Taxable brokerage accounts are for business owner wealth building. Employees need tax-deferred growth because they can't optimize current taxes. But self-employed people can reduce current taxes through deductions and build leverageable wealth simultaneously. So I stopped contributing to retirement accounts entirely and redirected everything into taxable accounts, and within 18 months, I had my first securities-backed line of credit. A securities-backed line of credit, or SBLOC, is a loan offered by your brokerage where you borrow against the value of your stock portfolio without selling anything. Most major brokerages offer this. Fidelity, Charles Schwab, E times Trade, Interactive Brokers, and the terms are shockingly favorable compared to any other type of loan. Let me break down exactly how these work, because the structure is unlike any loan you've ever seen. When you have $100K in eligible securities, typically stocks, ETFs, mutual funds, but not options or penny stocks, the brokerage will extend you a line of credit for 50-70% of that value. Let's say $60K. You can draw on that line anytime, use the money for anything except buying more securities, and you only pay interest on what you actually borrow. The interest rate is typically tied to the federal funds rate plus a small spread. So in 2024, rates range from 3 to 6% depending on your balance. Compare that to credit card rates of 1, 8, 24% or personal loans at 10, 15%. And here's the insane part. There's no repayment schedule, no monthly minimum payment beyond the interest, and no credit check required because the loan is secured by your portfolio. The only way you default is if your portfolio value drops below the required maintenance level, which is why you never borrow the full 70%. Conservative borrowing is critical. If you borrow 40-50% of your portfolio value, instead of maxing out at 70%, you have a massive buffer for market downturns. For example, if you have $100K in stocks and borrow $40K, your portfolio would have to drop 50% before you hit margin call territory. The S&P 500 has never dropped 50% without eventual recovery. And even during 2008, the max drawdown was 56%. So as long as you're not over-leveraged, you're essentially risk-free. This is the exact leverage structure billionaires use. Borrow conservatively against appreciating assets, let the assets continue growing, and never sell. Now, let me show you how Rachel deployed this. Remember, after 3 years, she had $78K in her brokerage account. She opened an SBLOC with Fidelity, got approved for a $47K line of credit, and drew $35K to cover the down payment and closing costs on her first rental property. She paid 4.5% interest on the $35K, which was $1,575 annually. But the rental property generated $1,400 per month after all expenses, so the property cash flow covered the loan interest with $15,225 left over. That $15,225 in annual rental profit went directly back into her brokerage account, accelerating the next property down payment. Meanwhile, the original $78K in stocks continued growing at 8% annually, adding $6,240 in value the first year alone, so she effectively got a rental property without losing any stock portfolio growth. This is asset layering, using one asset to acquire another without selling the first, creating multiple compounding engines that all work simultaneously. After 2 more years, Rachel had $112K in her brokerage, one rental property with $68K in equity, and enough cash flow to open a HELOC on the rental a home equity line of credit that let her borrow 75% of the property's equity, which was $51K, at 6.5% interest. She drew $45K from the HELOC and used it to buy her second rental property, same strategy, different collateral source, and now she had 2 properties producing cash flow and 2 leverage sources compounding. Let's pause and look at Rachel's full wealth structure at year 5, $112K in stocks that continue growing. 2 rental properties worth $420K combined with $138K in equity. Total cash flow of $2,800 per month from the rentals. And her business still producing $150K plus in annual income. Her tax strategy is what makes this truly powerful, because almost none of this wealth building triggered additional tax liability. The stock portfolio appreciation, not taxed until sold, which she'll never do the rental property appreciation, not taxed until sold, which she'll never do the SBLOC and HELOC loan proceeds, not considered income, so not taxed at all. The only income she paid tax on was her business income, which she'd already optimized through legitimate deductions. This is how self-employed millionaires build $500K minus $2M in net worth, while showing $80K minus $120K in taxable income. The wealth compounds outside the tax system entirely. But you're probably thinking, what about the loan interest? Isn't that eating into returns? Great question, and here's the math. Rachel paid $1,575 on her SBLOC and $2,925 on her HELOC. Total annual interest of $4,500, but her assets appreciated by $47,000 that year and produced $33,600 in cash flow. So she paid $4,500 in interest, but gained $76,100 in total wealth. The interest cost was 5.9% of her wealth increase, and it allowed her to keep all her original assets compounding. Compare that to if she had sold $80K in stocks to buy the properties outright, she would have paid roughly $12,000 in capital gains taxes, lost all future growth on the $80K sold, and yes, she'd have no interest costs, but also no original stock portfolio compounding. The math isn't even close. This is the core insight of buy, borrow, die. You're paying small interest costs to preserve massive compounding potential, and over decades, the math is exponentially in your favor. Now, let me address the psychological barrier most people hit here. Debt feels scary, especially if you grew up being taught that all debt is bad and you should pay off everything as fast as possible. But that advice was designed for employees with consumer debt, not business owners with strategic leverage. Your parents were right to avoid credit card debt at 22% interest. They were wrong to avoid 4% debt secured by appreciating assets. The mental shift Rachel had to make was understanding that she wasn't going into debt to buy liabilities, she was using leverage to acquire more assets without giving up existing assets. Every dollar of debt was backed by $2 of collateral, and the collateral was producing income that exceeded the interest cost. Once she saw debt as a tool instead of a threat, her wealth velocity tripled, and that's the exact mindset shift that separates millionaires from everyone else. Let me give you the exact action steps for setting up your first SBLOC, because this is the unlock moment for most self-employed people. First, you need at least $50K in eligible securities in a taxable brokerage account at a major institution like Fidelity, Schwab, or E-Times Trade. Second, contact your brokerage and ask specifically for a securities-backed line of credit or portfolio line of credit. Don't call it a margin loan. That's different and has higher rates. Third, they'll evaluate your portfolio and offer a credit line, typically 50-70% of value, accept it, but only draw 30-40% initially to maintain safety buffer. Fourth, use the proceeds for cash flowing assets or business growth, never for consumption or buying more stocks. Fifth, set up automatic quarterly interest payments from your business account so you never miss a payment and maintain perfect credit line standing. The entire process takes 7 to 14 days from application to funding, and once it's set up, you have permanent access to low-cost leverage anytime you need it. This is the exact tool billionaires use, and you can access it with $50K in assets. But SBLOCs are just one leverage source. The wealthy use multiple simultaneously, and each one serves a different purpose in the wealth building system. Leverage source 2. HELOCs on rental properties. Once you have equity in real estate, you can open home equity lines of credit that function exactly like SBLOCs but are secured by property instead of stocks. Rates are typically 1 to 3% higher, but you can access 85% of your equity. Rachel used HELOCs to fund subsequent property purchases, creating a self-perpetuating cycle: buy property, build equity, extract equity, buy next property. Leverage source 3, business lines of credit. If your self-employed business has consistent revenue history and good cash flow, you can qualify for business LOCs from banks like Chase, Bank of America, or American Express, with limits ranging from $10K minus $250K at rates of 7-12%. These are higher interest than SBLOC, so you only use them for business investments with clear ROI, buying equipment that increases capacity, hiring help to scale revenue, or covering operational gaps during growth phases. The key principle across all leverage sources is this: borrow at rates lower than your asset appreciation rate. If your stocks grow at 8% and you borrow at 4%, you're arbitraging a 4% spread. If your rental appreciates at 4% and produces 6% cash-on-cash return while you borrow at 6.5%, you're still net positive when you factor in equity buildup and tax benefits. This is the mathematical foundation of wealth. Grow assets faster than you pay interest, never sell to avoid taxes, and let time compound the difference into millions. But here's the critical discipline point. You cannot let lifestyle inflation destroy this strategy. I've watched self-employed people build $200K in assets, open leverage lines, and immediately spend the borrowed money on cars, vacations, and upgrades. That's wealth destruction, not wealth building. The rule is simple. Borrowed money goes into appreciating, income-producing assets or business growth with measurable ROI, never consumption, never lifestyle, never ego purchases. Rachel followed this religiously. Every dollar borrowed went into rental properties or business systems that produced more cash flow than the interest cost. She kept her personal lifestyle at baseline no matter how much access to capital she had, and that discipline is why she reached $1 4M in net worth within 7 years. 7 years, $1. 4M in net worth, and she paid taxes on less than $90K in annual income most of those years because the wealth built outside the tax system entirely. So to summarize the borrow phase, use CLOCs for liquid leverage against stocks at 3 to 5%, use HELOCs for equity extraction from real estate at 6 to 8%, use business LOCs for operational growth at 7-12%, borrow conservatively at 30-50% of collateral value, only borrow for appreciating assets or high ROI business investments, and automate interest payments to maintain perfect standing. Once you've mastered buy and borrow, there's one final piece that locks in generational wealth forever, and it's the most misunderstood part of the entire strategy. Before I explain the die phase, let me show you the most common mistake people make in the borrow phase that causes catastrophic failure: over-leveraging during market peaks. This happened to thousands of people in 2008 and again in 2022. And it's completely avoidable if you understand one simple rule. The rule is only borrow when your portfolio is up significantly from your cost basis, and never borrow more than 40% even if 70% is available. If you bought stocks at $100K, and they've grown to $180K, You have $80K in unrealized gains borrowing, $50K against that gives you massive buffer. Even if the market crashes 40%, you're still above margin call threshold. But if you bought at $95K and it's at $100K with only $5K in gains, don't borrow yet. Patience and discipline separate wealthy people from liquidated people. Now let me show you how the die phase makes all of this permanent. The die phase sounds morbid, but it's actually the most brilliant tax arbitrage in the entire system. It's called the step up in basis at death, and it's how wealthy families transfer hundreds of millions tax-free across generations, while everyone else pays estate taxes, capital gains, and inheritance taxes. Here's how it works and why you should never sell your appreciated assets if you're building generational wealth. Let's say you bought $100K in stocks 30 years ago, and they've grown to $2 million. If you sell them during your lifetime, you owe capital gains tax on the $1. 9M gain, which at 20% federal plus 3.8% net investment income tax plus state taxes could be $450K minus $550K depending on your state. But if you never sell and instead borrow against the $2M for living expenses, you pay zero capital gains tax during your lifetime, and here's where it gets insane. When you die, your heirs inherit the assets at their current market value. That $2M portfolio that you bought for $100K now has a stepped up cost basis of $2M in your heirs' hands, meaning if they sell it the day after you die, they owe zero capital gains tax because there's no gain relative to the stepped up basis. The IRS just forgave $1, 9M, in taxable gains permanently, and this isn't a loophole, it's explicit tax law under IRC Section 1014. So the optimal strategy is this: buy assets, borrow against them for living expenses instead of selling, die with the assets still in your estate, and your heirs inherit them tax-free with a stepped-up basis. The loans you took out, they're repaid from the estate, but since the estate gets the step up, there's still no capital gains tax on the sale. Let me show you exactly how Rachel's $1 4M at age 41 becomes $15M tax-free for her kids using this exact structure. Rachel is 41, has $1, 4M in total net worth, $520K in stocks, $880K in real estate equity. She continues borrowing against these assets to fund lifestyle and business growth, never selling anything, and the assets appreciate at a combined 6% annually for the next 35 years. By age 76, her portfolio has grown to $10. 8M still never sold, still compounding, still borrowed against, then she passes, and her two children inherit the full $10. 8M with a stepped up basis. The kids inherit $10. 8M in assets with a cost basis of $10. 8M, meaning they can immediately sell everything tax-free or keep it and continue the borrow strategy. The original $1 4M that Rachel built has turned into $10, 8M for her kids without anyone ever paying. Capital gains tax on the appreciation. And if the kids are smart, they continue the strategy, borrow against the $10, 8M, let it grow another 35 years, and pass $83M to their kids tax-free. This is how billionaire families maintain wealth for centuries. The Rockefellers, Kennedys, Waltons, they never sell, they only borrow, and every generation gets a step up in basis that resets the tax clock to zero. Meanwhile, working class families are paying capital gains, estate taxes, and income taxes at every transfer. The difference isn't intelligence or even starting capital, it's knowledge of the system and discipline to never sell. But you're probably thinking, what about estate taxes? Don't you pay 40% estate tax on wealth over $13? 6M? Yes, but there are strategies to minimize or eliminate estate taxes entirely. Spousal transfers, irrevocable trusts, gifting strategies, charitable remainder trusts, family limited partnerships, all legal structures the wealthy use. For most self-employed people building $2 M minus, $10 M in wealth, you won't hit estate tax thresholds. But if you do, you hire an estate attorney when you cross $5 M to set up protective structures. These are one-time costs of $5K minus $15K that save millions. Let me show you the most powerful estate planning tool for self-employed people building $3 M minus $20 M. It's called an irrevocable life insurance trust, or ILIT. And it removes life insurance proceeds from your taxable estate while providing liquidity for heirs to pay any estate taxes or loans without selling assets. Here's how it works. You create the trust, transfer ownership of a life insurance policy to the trust, make annual gifts to the trust to cover premiums, and when you die, the life insurance pays out to the trust tax-free outside your estate. For example, Rachel at age 41 could buy a $5 M life insurance policy with annual premiums of $8,000, place it in an ILIT, and gift the $8K to the trust each year when she dies. Her estate might owe $1, $2 M to pay off loans she took during her lifetime, plus potential estate taxes. The ILIT pays those from the $5 M tax-free, and the heirs still inherit the full asset portfolio. This ensures the heirs never have to sell assets at bad times to cover debts. They have cash liquidity from the insurance while inheriting the full stepped-up asset base. Another critical strategy is annual gifting. In 2024, you can gift up to $18,000 per person per year without triggering gift tax, and it doesn't count against your lifetime estate exemption. So if you have 2 kids, you can gift each of them $18K annually. Your spouse can too, totaling $72K per year, flowing to the next generation tax-free. Over 30 years, that's $2. 16 M transferred tax-free before you even die. And if the kids invest those gifts, they're building their own stepped-up basis portfolios simultaneously. Now, let me address the ethical question some of you are thinking. Is it fair that wealthy people can avoid taxes like this while employees pay full freight? Look, I'm not here to defend the tax code or argue fairness. I'm here to show you the rules as they exist and how to use them legally. The tax code was written by wealthy people for wealthy people. Employees weren't meant to build generational wealth. They were meant to fund government operations through payroll taxes. Business owners were given incentives to invest, create jobs, and take risks. You can be mad about that, or you can acknowledge the game being played and decide whether you want to play it. Self-employment gives you access to the business owner tax structure, and if you don't use it, you're voluntarily paying more taxes than legally required while building less wealth for your family. The system rewards business owners, asset accumulators, and job creators. If you're self-employed, you qualify for all 3. The only question is whether you'll learn the rules and play the game. So to summarize the die phase, never sell appreciated assets during your lifetime. Borrow against them instead to avoid capital gains. When you die, your heirs inherit with stepped-up basis, eliminating all accumulated gains. Use ILITs to provide liquidity for loan repayment and estate taxes, and implement annual gifting strategies to transfer wealth pre-death tax-free. This is the complete buy, borrow, die system, and now I'm going to show you the exact implementation timeline for a self-employed person earning $100K minus $200K. Let's say you're 35 years old, self-employed, earning $150K annually after business expenses, currently have $20K in savings, and you're ready to build generational wealth. Instead of just high income, here's your exact 15-year roadmap using buy, borrow, die. Years 1 to 3 are the foundation phase. This is where you build your first $100K in leverageable assets. Foundation phase, years 1 to 3. Live on $60K annually. Invest $90K per year into taxable brokerage account, 60% in S&P 500 index funds, 30% in dividend aristocrats, 10% in REITs. Max your SEP IRA with $20K annually for tax optimization. Save $15K in HISA for rental property down payment fund. By end of year 3, you have $295K in taxable brokerage, $65K in SEP IRA, $48K in down payment fund total, $408K in assets ready for leverage activation. Acceleration phase, years 4 to 7, open SBLOC on your $295K portfolio. Borrow $110K at 4% to buy first rental property with $45K down payment. Keep $65K as emergency reserves rental produces $1,600 month after expenses, covering SBLOC interest plus $14,400 annually back into investments. Continue investing $90K annually from business income plus $14K from rental, totaling $104K per year by end of year 7. You have $680K in stocks, one rental worth $420K with $145K equity. Multiplication phase, years 8 to 12. Open HELOC on first rental for $109K, 75% of equity. Use $48K to buy second rental property. Invest remaining $61K in stocks. Rental 2 produces $1,500 month. Now total rental income is $3,100 a month, with $22,000 annual excess after all debt service. Stock portfolio grows to $1. 2M. Real estate equity reaches $380K. Total net worth $1. 58M by year 12, and you've never paid capital gains tax on any growth. Perpetuation phase, years 13 to 15. Open second SBLOC on $1. 2M stock portfolio. Borrow $350K to buy third rental or invest in private business equity. Total passive income from rentals now $4,800 month. Dividend income $28,000 year. Combined $85,600 annually. This exceeds your $60K lifestyle baseline. At age 50, you have $2, 3M in total net worth, $85K in annual passive income, and your business income is now optional. You've achieved financial independence in 15 years. From age 50 to 85, you continue the strategy, borrow against assets for lifestyle spending, never sell anything, let everything compound at 6% annually by age 85. Your $2. 3M has grown to $15, 8M, all with stepped up basis, ready to transfer to heirs, tax-free, total taxes avoided, approximately $3. 2M in capital gains. This is the complete system. Buy appreciating collateral, borrow against it instead of selling, die with stepped up basis for heirs executed over 50 years, built from $150K self-employed income. Now let me show you the 3 biggest mistakes that destroy this strategy, because I see self-employed people make these constantly. Mistake 1, building assets in the wrong account types. If all your money is in IRAs and 401ks, you can't borrow against it, and this entire strategy is dead. You need taxable brokerage accounts as your primary wealth vehicle if you're self-employed. Retirement accounts are secondary tax optimization, not primary wealth building. Mistake 2. Over-leveraging during market peaks. Borrowing 70% of your portfolio value when stocks are at all-time highs means a 35% market correction, triggers margin calls, and forced liquidation at the worst possible time. Never borrow more than 40%, and only when you have significant unrealized gains as buffer. Greed destroys more wealth than any market crash. Conservative leverage preserves capital through all cycles. Mistake 3. Using borrowed money for consumption instead of assets. The moment you borrow against your portfolio to buy a boat, car, or vacation, you've converted wealth-building leverage into wealth-destroying debt. Every borrowed dollar must go into appreciating assets or cash-flowing investments with returns exceeding the interest cost. The discipline to deploy borrowed capital correctly is what separates millionaires from broke people. With asset accounts, both have access to leverage, only one uses it wisely. So here are your immediate action steps. Tonight, open a taxable brokerage account if you don't have one. This week, calculate your baseline living expenses and set up automatic monthly transfers from business account to investment account. This month, research SBLOCs at your current brokerage and understand the terms even if you're not ready to use one yet. These 3 steps cost $0, but set the foundation for the entire buy, borrow, die system, and that brings us to the final truth you need to understand about self-employed wealth building. You started this video thinking the ultra-wealthy had access to some secret illegal tax strategy, but now you understand buy, borrow, die is completely legal, explicitly encouraged by the tax code, and accessible to any self-employed person earning over $100K who has the discipline to execute it. The barrier isn't money, connections, or intelligence, it's knowledge and discipline, both of which you now have. Self-employed people have an unfair advantage over both W-2 employees and trust fund heirs. Employees can't optimize current taxes or control income timing. Heirs never learn the discipline of building from zero, but you get tax optimization, income control, and the hunger to build. That's a lethal combination. The people who execute this system aren't smarter than you. They just committed to playing the game instead of complaining about the rules. If you're self-employed and you're serious about building generational wealth instead of just high income, subscribe to this channel. Every video breaks down the strategies, psychology, and systems that turn self-employment into a wealth-building machine. I don't sell courses, I don't pitch masterminds, I just deliver the playbook. Hit the like button if this changed how you see taxes and wealth building. This information needs to reach everyone building outside the W-2 system. One final thought before you go, and this is the mindset shift that changes everything. You're not just self-employed, you're a business owner with access to the same wealth-building system that created every major American fortune. The only difference between you and them is time and execution, so start today.